For decades, macroeconomics had this really serious puzzle on its hands, a core contradiction in how we think about investment. See, when you look at individual companies, they invest in these big, rare bursts. But when you zoom out and look at the whole country, investment looks smooth and steady. How can that possibly be? Well, today we're unpacking the brilliant paper by Ricardo Caballero and Eduardo Engel that finally solved this mystery, earning them the 2002 Frisch Medal and really changing the field forever.
So here's our roadmap for solving this economic detective story. First, we'll really lay out the puzzle. Then we'll look at the old models and figure out why they just weren't cutting it. After that, we'll dive into Caballero and Engel's new theory, see how they proved it with real-world data, understand how it literally changed the entire field, and finally, look at its lasting legacy. Let's jump in. All right, let's kick things off with Section 1, the investment puzzle. Our story starts with a very specific question that was giving economists a massive headache for years. And it all boils down to this clash between what we see up close versus what we see from a distance. And this, right here, is the central mystery. If you look at a single factory or a single company, they don't invest a little bit each year. Nope. They do pretty much nothing for long stretches of time, and then bam, they build a whole new plant or overhaul an entire assembly line. It's lumpy. But when you zoom out and look at the GDP numbers for the whole country, total investment looks like this smooth, flowing river. How on earth do all those jerky, lumpy decisions add up to something so continuous? You can see why this was such a big deal. The theories economists were using in their big models, the ones that were supposed to explain the whole economy, just didn't match what was happening on the ground. These models all predicted that firms should be constantly fine-tuning their equipment, making little adjustments all the time. But the actual data, it told the exact opposite story. This wasn't just a minor error. It was a fundamental conflict between theory and reality.
So that brings us right to Section 2, the limits of old models. To really appreciate the breakthrough that's coming, we first need to understand why the existing economic models were getting this so wrong.
Okay, so the problem was buried deep in the assumptions of the old models. They were all built on this idea called convex adjustment costs. Now, that's a fancy term, but the idea is simple. It means the cost of making a change gets progressively higher the bigger the change is. So it was always cheapest to just make lots and lots of tiny changes. But in the real world, what we actually see are fixed adjustment costs. Think about it. You don't build 1/10 of a factory. You either build the whole thing or you don't. And that massive one-time cost is what forces companies into those lumpy, all-or-nothing decisions. Now, economists did have a model for this lumpy behavior, at least for a single firm. It's called an SS policy. Imagine you have a perfect target level for your equipment. You let it wear down, or maybe your needs grow, but you do nothing. You just wait until it hits a lower trigger, let's call it S, or an upper trigger, S. As soon as it hits that line, you make one big investment to get right back to your target. This described the reality for a single firm perfectly. And here we are, right back at the heart of the puzzle. The S model was great for one firm, but it created this huge aggregation problem. I mean, if you just add up a million lumpy, jerky decisions, you should get a lumpy, jerky national total, right? But we don't. So what was the missing piece? How does the economy manage to smooth out all of this chaos at the micro level? That very question leads us to Section 3, a new theory of aggregation. This is where Caballero and Engel step into the story with a truly brilliant idea that finally connected the dots. So here's their breakthrough. They argued that to understand total investment, you can't just look at an economic shock, like a change in interest rates or something. You have to look at the state of all the firms before the shock even hits. What you really need to know is the distribution. How many firms are right on the edge, ready to invest, and how many are sitting comfortably far away from their trigger point? They built their whole model around this new concept they called the adjustment hazard. So instead of a hard, rigid trigger where a firm goes from a 0% chance of investing to a 100% chance, they pictured something, well, smoother. The further a firm's equipment gets from its ideal target, the higher the probability, the hazard, that it will finally decide to pull the trigger and adjust. It's not a light switch, it's more like a dimmer ramp. Let's use an analogy here because it makes it crystal clear. Picture a huge crowd of people waiting at a crosswalk. Every person in that crowd is a firm. Their level of impatience to cross the street is like a firm's need to invest. The adjustment hazard, then, is just the growing likelihood that any one of those people will get fed up and just dart across the street. And this is the magic insight. The effect of an economic shock, our traffic light changing, depends entirely on the distribution of that crowd. If most people are already right there at the curb, toes on the line, and the walk sign flashes, you get this massive surge of people crossing all at once. That's a huge investment boom. But what if most people are hanging way back, checking their phones far from the street? Well, that same walk sign will only cause a tiny trickle to cross. You get a totally different response to the exact same shock.
So their logic really just boils down to a simple three-step process. First, for any one firm, its capital gap, how far it is from its target, determines its probability of investing. Second, at any given moment, we can look at the distribution of all those gaps across the entire economy. And finally, that distribution is what determines the economy's total response. It's the state of the crowd that tells you everything.
Which brings us to Section 4, Evidence from the Data. I mean, a beautiful theory is one thing, but the real test is whether it actually works in the real world, and the work they did here is what really earned them the Frisch Medal. Caballero and Engel took their model to the data, using over 4 decades of information on U.S. manufacturing. And here's the incredibly clever part of what they did. They didn't actually need to have data on every single company. Their framework was so powerful that it allowed them to estimate the shape of that crucial adjustment hazard using only the big picture, sector-level data. They could basically see the micro behavior just by looking at the macro patterns.
And what they found was a total home run. The data confirmed every single key prediction of their model. Most importantly, it showed that this distribution of capital gaps was the missing ingredient, the key to explaining why aggregate investment goes up and down. And this also explained other weird mysteries, like why the economy sometimes responds explosively to a shock and other times barely reacts at all. And that has huge implications. It means, say, a central bank could cut interest rates and get a huge boom one year, and do the exact same thing a few years later and get almost no response, all because of the hidden state of the economy's crowd.
So let's move on to Section 5, How One Paper Changed Macro. Because the publication of this paper wasn't just another small step forward, it was a genuine paradigm shift for the whole field. I mean, this really paints a stark before and after picture. Before this paper, the standard way of doing things was to model the entire economy as if it were just one giant representative firm that always acted smoothly. It was a simplification, sure, but it completely missed that lumpy reality. After Caballero and Engel, the whole frontier of macro modeling shifted to building models from the ground up, with lots of different or heterogeneous firms, each making their own realistic, lumpy decisions. And this is the profound conceptual leap they gave all of us. The smoothness we see at the national level, it isn't there because every firm is acting smoothly. It's what we call an emergent property. It arises simply because at any given time, the lumpy decisions of millions of different firms are not synchronized. They just average each other out. Macro stability does not require micro stability. Finally, let's talk about Section 6, the lasting legacy. Because the influence of this one paper goes way beyond just studying investment. It basically provided a brand new toolkit and a whole new way of thinking for macroeconomics. You know, their work was part of this larger intellectual revolution in econometrics. As another Frisch Medal winner, John Rust, put it, the goal was this bottom-up approach. Instead of imposing big assumptions from the top down, the new frontier was to build our understanding of the whole economy by first understanding the nitty-gritty behavior of individual agents like firms, and then carefully adding it all up. Their framework became absolutely foundational. It spurred the development of this entire field of what we call heterogeneous agent macro models. It gave us new tools for studying things like irreversible investment, for building much more realistic models of the business cycle, and for pretty much all modern research on how firms behave over time. So, to wrap it all up, what's the big takeaway here? Caballero and Engel took a fundamental puzzle, this clash between lumpy microinvestment and smooth macroinvestment, and they completely solved it. They showed us that the key wasn't just the shock itself, but the distribution of firms ready to react to that shock. And in doing that, they taught us a really profound lesson. Sometimes, the apparent calm of the big picture economy is just the beautiful statistical outcome of a million chaotic decisions all happening underneath the surface.